What's up, Outliers? Happy Wednesday. Hope everybody's week is going awesome and you're ready to poke through the markets together as a group. I'm not going to waste time going through broad market trends and stuff like that. We really just did that yesterday. So I want to spend a little bit more time diving into some specifics. First and foremost, there's general pullback occurring, and we are still seeing similar leaders and laggards with respect to sectors in sector performance. Volatility remains low, although volatility is trickling higher. It's now in like the low 15 handle from the low that we saw back in, what was this? 24 December, we're at 1338, which is very low. It, by the way, absolutely can go lower than that, but that's just super, super low, especially given the broader state of affairs in the world right now. I absolutely would not consider everything, super mellow across the board and ultimately stable. I think, as usual, there is a whole lot going on across the market that continues to at least draw my general interest. I do want to talk about two recent positions. We talked about these yesterday. We identified these on Sunday, actually during the pro market prep stream. And both of these performed a little differently today comparatively, but I find them interesting. So ONDS had about a 5% pullback on the day. This is still well within standard breakout territory. We also looked at AXTI, which had its continuation. I did end up following along today. I think we talked about this one as well on Sunday for like a ratio call diagonal. One note is that I'm not running ratio call diagonals yet. These are simply long calls. These are trading breakouts. Depending on how they end up shaping up will determine if I turn them into longer term positions or not. And then the other that we looked at was Rocket Lab, which also still looks pretty solid today for some of our recent directional ideas. The portfolio right now continues to be balanced. I'm only 80% utilized. I'm 81.5% utilized, which actually I think it's a little bit lower than that right now. Main thing is I'm able to get enough on, and I'm not having to run the portfolio too hot to look for opportunities, which is actually kind of the theme for today. I want to talk a little bit about navigating these low volatility environments. I think, So I recently put out a video on this. I'll throw that in the chat for you guys here. And it talks about essentially this kind of stuff, right? Like finding ideas when the market is giving you different looks. And right now, the primary look that you're getting is absolutely compressed volatility. This, again, if we zoom this out to get longer term context, you can see over a 10-year time frame, we're hovering around the -1 standard deviation channel. So we're definitely still within normal bounds. We haven't exceeded normal bounds yet, but we absolutely are at the lower end off of the mean, where our mean here is like 2040. So we are a decent ways off of that. On longer term timeframes, this does start to shape a little bit differently. We still are below the 30-year mean, but the 30-year mean is lower. The 30-year mean is like the mid 18 handle, something closer to that. The reason for that is because over these really, really long periods, you actually capture the mean reverting tendencies of volatility outright. But in these shorter term timeframes, even when we're talking over periods of 5 years, 10 years, those can be skewed if there's a higher concentration of outsized stuff like this. That's a really important point to drive home, is this idea of path. A lot of traders have really, really warped perception of time, duration, traders will feel like they've done something for a long time if they've done it for 3 years. And that's not a trivial amount of time, but that is literally a drop in the bucket. You could experience a completely isolated period of the market over a 3-year time frame that doesn't actually represent what the market does. And those kinds of people that aren't wise enough to zoom out and force themselves to look at different periods that might be in sample or out of sample, but force themselves to zoom out and look at some of these other periods can be fooled massively. It's easy, really easy to be fooled by these kinds of conditions. And I'll show you a little bit about what I mean. If you go back over 20 years and you look effectively from 2012 all the way up until 2019, you didn't really see much of a downtick in S&P. So if you traded this 6.5, almost 7-year window, you only saw one pitch. That's it. And this is something I used to talk about a lot because I started trading in 2007. From my start in 2007, I still have not seen that many bear markets. Most of them, the critical mass of the bear markets I experienced, as you could tell, have effectively been from COVID on. That is the nature of path. The way that you manage path in markets is by purposefully exposing yourself, not to children, but to different market conditions. Because if you're able to do that, then you have ideas on how your strategies will behave across different market regimes. And you have to purposely do that. If you don't, you're going to get caught off guard massively. And this is exactly why when we talk about something like the outlier strategy process, there's a key function in here. And I'll show you exactly what we're talking about here. Inside the outlier strategy process, when we're going through this exercise of analyzing profit mechanisms, testing different structures, in this step here, when it says test performance, this test performance is effectively doing several different tests. There's back tests, there's forward tests, there's live tests for performance. And the reason for this is because you get different kinds of looks based on this. So back test is going to give you in sample performance. How did something do within conditions that we've seen before? Forward testing is when we're trying to expose a strategy, not to children, but to out of sample conditions. That's stuff like training data and then running Monte Carlo simulations. That whole point of training data in this context is so that it's not completely random and completely irrelevant to what we're doing, but it can fall within somewhat similar parameters based on data that you give it. So a way to make this clear in case this is novel to you is you can download price data for an underlying that you're interested in. Let's say the SPX. You can download price data in SPX. Then you can use that in something like Python. You can use really whatever platforms you're comfortable with. It's not something that I would bother in PowerShell. It is really good in stuff like R. R is awesome for running different kind of statistical studies and regressions. But what you do is you feed platform of your choice that data. And what I would do is give it that data in different snippets, intraday, day level, week level, month level, so that it has different views on how this stuff performs. And then I maybe add the other indices just for posterity's sake. So grab NASDAQ, probably just NASDAQ, because small caps are starting to get into something a bit different. I would give it all of that data, and then I would say, use this data to parameterize some sort of Monte Carlo simulation. Then you can run 10,000, 20,000, 50,000 Monte Carlo simulations off of data that is novel, it's new, but it's made somewhat relevant to the stuff that you're actually trading. If you don't do that training process, then the Monte Carlo sim doesn't know anything. So as it's printing open, high, lows, low closes for you, it could print something that's at like 2 pennies, and then later in that day it's at $10, right? It's stuff that just doesn't really reflect what you're actually attempting to look at. Okay. If there's any questions on that, I would love to hear those, but that leads us to the current market condition. And the whole reason for that monologue is because this market condition is probably somewhat new to a lot of people. We've not experienced markets that are in this deep level of suppressed vol for any sort of long duration. We've had a couple periods back here where we would tap in like the 14s, but it's like for like 5 days before you start getting it back up in the 18s. What's different here is that we've been below the 15 handle since 19 December, or trading right around that 15 handle since 19 December. So it's been a minute. This is a little bit different. A lot of your strategies will look different in these kinds of markets. A great example of this is the way that I trade zero DTEs. Zero DTEs have changed massively because of the current vol, meaning I'm skipping most days as of December, but I'm also, anything I put on is being sized down massively. And it's because the volatility is so low. What ends up happening is if you're trading zero DTEs, you can easily find yourself, even if you're trading with wings, let's say that you trade them 15 points wide, 20 points wide, 25 points wide, whatever. And let's say in general, as you put on that 15 point wide wing, you might have $1,100 or $1,100 in risk or something like that. That would make sense in that scenario. When vol is this low, you have way more risk. The way that you can manage that is by tightening the wings, because it gets cheaper to tighten the wings. An example of this, I don't know if this will let us go back to 24 December. Well, on demand, I don't know if that's too soon, but that would be really cool if we could. Let's see. We can. That's great. So we'll go to 24 December really quick. Yeah, this is literally awesome. And let's say that we're going to be at least a little later in the day. We don't want to do it too soon after the open. And let's take a look at what a zero DTE will look like in here, just in terms of what you collect. And then we'll take a look at another scenario. Okay. So zero DTEs in here. Does this look right? This looks not right. Try like maybe not. I just want to see if these change and what they change. Something weird is going on. Obviously the deltas are completely wrong and stuff, but anyways, let's just take a look at an example. Let's say that you're doing something that's like right at the money, which is the 69.35s. So let's say that you sell the straddle. The straddle you're getting here for $4.80. Let's say that you get wings that are 15 points wide on each side. So I'll grab a sheet so that we could track these really quick. Get rid of all of that stuff. And I just want to track the calls and the puts really quick. Okay, so we already said that VIX here is like 13.5. Now, a super important note is aligning the terms with the vol that you're trading. Remember, you're not trading VIX here. You're not trading 30-day vol. You are trading 1-day vol. The thing that you're trading here is different, and it's important to pay attention to that. Okay, so for the call and the put, we'll have our strike, delta, premium. Okay. So the strikes will be the same, 69.35. The delta for our call, it's wrong. I'm just going to guess it's about a 50 delta. I don't know, but that's my guess. This is saying our premium is like 275 on the call side. And then on the put side, we're at like 205. So that gives us our net of 480. Now let's add the wings. The wings we're looking at 15 points wide. So that takes us here on the put side to the 69.20s. Again, I'm not even going to bother with the deltas actually, just because I have absolutely no idea what they are. And it's clearly incorrect. And the premium for those is like 0.07-ish. On the call side, the 50s. Premium here is like 17 cents. That gives us 24 cents net premium, 456. Now let's go to a different day. We'll come out of on demand. We'll find another day. We don't need to look for when like vol is crazy. And again, I'm just using VIX here as a proxy. This isn't the complete accurate way to do this. Let's say we grab it here when vol was at like the 24 handle on 18 November. 18 November here. And then we're literally just going to repeat that exercise really quick so that you can see the difference between these conditions and how these things behave really completely differently in these different time frames. Okay, so now we're looking, vol was like 24, we said. Then I'm going to copy the same format. All right, let's take a look at the zeros. The deltas look completely wrong, but the rest of it doesn't look too far off to me. So what are we at? 65.99. So the 6600s will be our number. 6600. The put side is 18.95. The call side is 18.60. We go 15 points wide here. On the call side, that puts us 66.15. Our premium that we're going to cough up here is like 11.90. Yeah. Put side here, 65.85. Premium is 12.45. So take a look at the difference between these. In these two different scenarios, when VIX is at 13 versus when VIX is at 24. Now, again, most people will intuitively know this, which is awesome. I definitely would hope so. But for those that don't have that same relationship with options and vol and how this stuff plays together, I want you to notice how massive the difference is between these metrics. Effectively, there's $8.64 premium variance, which is 189%. The difference between your VIX levels here, again, to reiterate, this is an imperfect way to track this. I just don't have the actual vols handy. But the difference here is 10.5 points. This is 77 0.8%. Notice the difference here. Notice how big this disparity is between how much vol changes and what kind of impact that has in terms of your premium on these widths. So the cool thing that you can do in instances like this is you can very, very easily identify points where this happens, and you can widen out your strikes if you want. Why? Because if you think in this scenario, well, really in both scenarios, we're 15 points wide. So your max risk in this trade, I'll do it backwards so that you get a negative number, is $10.44. Your max risk in this trade is $1.80. Notice the difference. When vol is low, what I would seek to do if I was trading with these wings is I would tighten them up. I would tighten them up because the incremental cost between being at 69.50 on the calls and 69.60 is going to be trivial. It's going to be very, very small. It's not going to make a big difference, but it's going to have a big potential difference on my P&L. And then the same thing happens, but in an inverse manner here, where if we go just a little bit wider, it's not going to massively increase our risk, but it will increase it incrementally, but will make more total dollars overall. So this is a way to manage volatility in something like zero DTEs. There's a complete other way. And by the way, the way that you figure all this stuff out is by testing. And again, it's by testing these kinds of things in different market conditions. Tomorrow, for example, during the stream tomorrow on skill development, we're going to look at a sector rotation strategy. The purpose for that is to see how that has evolved over time and to look for opportunities through sector rotation, because that's a completely viable methodology for finding alpha. It's, as always, just not typically as strong as what people would prefer to see, which, you know, that is what it is. All right. I'll talk a little bit more about finding and navigating low vol, but I want to see what you guys want to take a look at. So I see user that says, thank you for your videos. Oh, that's awesome. I'm glad that you've enjoyed. I was going through, saw a video about unusual option activity and how you interpret. I was looking at an example in CMCSA. Let's take a look. There, let me see what they're, okay, I see what they're doing. Let's see. CMCSA. Okay, so Comcast, this is a decent sized name. I can already tell you something very strange is going on because of the total OI against the volume today. Wait, what? This is saying 52. This is saying... What the fuck is happening? I'll have to look in something else. It's being fucked up because of these adjustments that it has. So you're looking at 20 Feb 26. Okay. The 25 put. Okay. And you see existing volume or existing OI. I'm getting fucked up by the thing here. So the volume is 33,990 and then the open interest was 219. Yep. Yeah. So this is a really good example of something interesting. It's super, super difficult without doing a bunch more homework in terms of what's going on. But one thing that I will note is that we are coming into earnings. So when there is earnings, more often than not, you'll find things do weird stuff. But this is still quite anomalous. Like, really, in the context of the total underlying and what the underlying typically trades. So let's take a quick look. Yeah, this. So this is an absolute massive spike in put premium, long put premium, which again, to me, looks like some sort of informed positioning, probably in preparation for earnings. That's my guess. So what is this? The 164s, or I'm sorry, 165,000 in premium in 16 Jan. When's their earnings? 29. Okay. And let's take a look. I don't want that one. I want this, which is on the put side. I'm seeing this is the wrong fucking underlying. Wondering why this stuff is all not looking wrong. This thing doesn't capture the whole fucking thing sometimes. Let's see what's going on here. That's hilarious. Because the super long put premium in that other name, CMC, that's worth investigating. That's actually hilarious. Let's go back there. That's absolutely hilarious. Through a fuck up in the ticker, we come across something real weird. Okay, so this has earnings even sooner. This makes way more sense. So this has earnings on the 8th before the market. If I was a betting man, which I am because I'm in the market, my guess is in CMC, somebody is expecting this thing to absolutely plummet. That's my guess based on what I see here. So that's honestly hilarious that we come across that by mistake. But this is a good example. This is a really good example. This is all in the front. So this is much nearer term. This is at the 70s. So let's take a look at the option chain. And let's take a look at the front here. And let's take a look at these. Yeah, the overwhelming majority of those are bought. User says, how to know if this trade is open to buy or open to sell? How to know if this premium selling or hedging against position? So the second part, you have absolutely no idea and you never will. You can use context clues to take a guess, but you'll never know definitively. Also, what's worth mentioning is just because something transacts at the bid or the offer also does not inherently tell you for certain that something was bought to open or sold to open. You actually don't know that either. Now, that being said, our reality as traders is we very rarely are going to work with any sort of perfect information. And the majority of the time, you have to get good at operating with imperfect information and making inferences. And there's a lot of different things that we can do to help with that. So things like duration, how long, what's the duration of the trade? How far in the money or out of the money are the options? Are there any context clues in terms of options being built up there over the last handful of days? All of these kinds of things kind of build a total picture as you learn how to pull together these different context clues. The fascinating thing here is that this absolutely looks like one of two things. Either somebody is directionally speculating to the downside on this name with those puts, or they're hedging a stock position. The way that you think about this is in either of those scenarios, it doesn't really matter which of those is the case. What matters is this is somebody that's clearly buying downside protection for one reason or another, whatever that reason is. And this is clearly around a catalyst. This is also in a smaller name. When you see stuff like this in really big names like Tesla, Nvidia, that is damn hard to tell what's going on because there's a ton of shit going on in names like that. But in slightly smaller stuff like this, it is absolutely a bit easier to try and decipher what might be going on and why. So this to me absolutely looks like the expectation of downside going through earnings. That's what I see here. Why it's happening, what the purpose is, what their portfolio looks like, all of those things we'll never know. But people don't put this kind of stuff on just for funsies. This is about $130,000 of premium that went on. Another thing that we can do is look at when the trades went through, which this is also absolute common behavior for more institutional professional level trading, which is trading towards the last hour, half hour of the day. More often than not, larger transactions are going to occur beginning of the day, end of the day. Towards the end of the day is when you see more of the professional traders, hedge funds, stuff like that. Beginning of the day, a lot of times, is structural needs. So things like pension funds that have to start rebalancing something and shit like that. They operate differently. They're a little bit more price insensitive. They're also not necessarily going to be in shit like this. This is going to be a bit small for them. But this came through at 108,000 here and then picked up a little bit more for another 16 here. So this, to me, absolutely looks like somebody expecting some kind of downside. Some kind of downside tomorrow would be my inference from this. So we'll see. We'll see how that pans out. I have no idea. This also isn't like some sort of huge position that I would make any sort of colossal bet around. But that is notable enough that I'll add it to my watch list here, literally just so that I can follow up and see how it goes. 70 puts away. Cool. So I have that on my watch list. So that's not the underlying that you were looking at, but a great, literally an absolutely perfect example, all the same for effectively the same reasons. Reggie says gold and silver pull back in metals soon or higher. Yeah, let's take a look. So let's take a look at gold. I would have thought gold would have stabilized and started to normalize / go down a little while ago. The fact that that hasn't happened tells me a little bit. But as far as catalysts, I still don't see some sort of insane catalyst to cause even the movement that we've monitored so far. With that, my base assumption would be momentum. I would expect it to continue exhibiting momentum. If we take a look really quick at the options chain, I'm using GLD for this just because it has options. I mean, the 50 delta is up here. Literally the at the money, and this is skewed because of vols, but it's at 412 when we're at 409. And the 409 is a 46 delta. So there's absolutely upside skew here, which is kind of crazy, but there is. How far out is the 30 delta? The 30 delta here is the 431s. And the 30 delta to the downside is at the 96s. That's huge. That is absolutely a profound gap. Take that and kind of let that sink in. What the market is telling you is that the 30 delta to the upside is at the 431s. The 30 delta, which is a probability distribution, that's all this is. This is the market's distribution of forward-looking probabilities. To the downside, it's at 396. So if we plotted this, the plot of this compared to the at the money would be absolutely skewed in actually a very cool way. I love those kind of visuals. Another way that you can mentally track this is by looking at the difference in the deltas as you go through these different strikes. So here's a quick example for you. Here, if we go from the 409s, 408s, 407. Here, your delta is 0.44, 0.45, 0.46. If we do that same exercise from the 410s, 411, 412, your delta goes from 0.53, 0.52, 0.51. So the variance between these is not huge, but take a look at the three strikes right about the money. The three strikes right about the money are all above 50 delta. You don't actually get to a 50 delta until literally you're kind of between these two at like the 412 and a half is right around where you're going to see the actual 50 delta. Whereas on the other side, you're already sub 50 deltas when you're right at the money. That's super strong skew. The market is, again, sharing its expectation of where things might go. Let's take a look really quick at this. I want to see what the skew looks like in here. This one's a little tougher to see. You're not used to looking at it. This white line is a 1 standard deviation range. So both of these will be at like 16%, give or take. So 16% probability of 460 versus 363. Yeah. Between that and momentum, I feel like I would favor the upside, but I don't necessarily want to be honest with you. I want to see this thing start normalizing and even starting to come down, because I actually think there's going to be a really good trade there when it does. Pretty clear that ain't happening just yet, or at least in the near future. So we'll see. Then there was a question in the Discord somewhere that I want to, here we go. All right. I didn't read this question yet, so I'm going to, well, first I'm going to take their name out of it just because I don't know what's in here. And then I'll pull up the question that I got for you guys. I don't know why I open it in here. I kind of forget that I can literally put it in here. Probably easier to see too. I don't know if it's easier to see. All right, let's see. So it says, what do you think of limited risk positions for iron butterflies? Maybe you have a video, but briefly, I feel like trading these profitably versus straddles is like 5 times harder for earnings. The spreads and entry/exits are rough. Also, don't have quantitative analysis yet on the P&L and the strikes of the wings, which I need to do. But it seems like a ton of work for not a lot of reward. I know the outlier mentality is to do it, but I have other strategies that I'm working on and limited time. Yeah, so this is a fair question. And it's because even though they already know the right answer is to do it, it is a little bit about economy of effort. The way that I think about doing this kind of stuff is the only way to know is to do the homework. You already can reason through what you likely are going to find. And I've personally ran analysis, like thousands of tests on different kinds of structures and strategies through earnings releases to capture vol and whatnot. But you already have an idea of what's going on here intuitively. The first thing that's going on is, any single time that you're adding wings, you're increasing your transactions. You also know that your overall drawdown will be not as bad depending on the width of the wings. If you're adding the wings just to effectively manage buying power, then that's a different story. Your drawdown is going to be just about equally as bad as being naked. But if you're adding the wings to help control risk and they're parameterized where they're not like a 2 delta, but there's stuff that's like between a 10 and a 30 delta, then you know that you're going to hurt your profitability, and you know that you're going to improve your worst losing trade. What you don't know is if your total profitability is going to go down because of the way that these behave. The only way to know the answer to that is to do the homework. When there's the question of, I have other strategies that I'm working on in limited time, this opens a different dialogue, which is that of prioritization. The way to think about what homework you're going to do and when is based on your prioritization, because I'm definitely not going to give you the answer to this. You need to do it for yourself. But I can absolutely help you prioritize what you're doing. The way that I would think about the different strategies that I want to test. So I have strategy A, B, C, D, E. There's a bunch of different ways to think about how I want to prioritize all of these. We'll add a couple more. The first thing is, what is my portfolio? What do I currently have? Right? So these are like test strategies. These are my current strategies. And let's say with my current strategies, I have 1, 2, 3, 4. And let's say I have something for upside drift. I have stuff for upside momentum. I have up and down breakouts. And let's say that I have one long vol. Well, the question you have to ask yourself is, which of these strategies do I think complements my current strategy suite the best? And it's not inherently picking something that's different than these. It's not inherently that. This is also why when you approach markets in the way that I talk about it with the outlier community, with us, it always starts with defining the goals. Because based on your goals, that's how you're going to determine what kind of stuff needs to live in here. And that's how you're going to determine, based on the stuff that is in here, what needs to be added. So a good example, let's say your trading goal is to maximize. You want the absolute best 5-year growth. What does that mean? Well, that means that I don't necessarily need to consistently be above zero, right? Let's say that if I have 1 year at negative 10%, let's say my next year is at positive 2%, my next year is flat, I'm at 0%, and then my next year, my fastball comes and I make 180%. Again, I'm just giving an example. And then let's say after that, I lose 5%. This portfolio is going to drastically outperform the portfolio that's up 2, 3, 2, 5, 2. Right? But this portfolio might be prioritizing consistency and drawdown constraint. This portfolio is saying, fuck the drawdowns. I don't care about the drawdowns. I am trying to make as much as I possibly can over some sort of moderately long period or whatever period. Based on what your goals are, it's going to inform what kind of stuff needs to be in here. The way you figure out how you want to prioritize these strategies and the ones that you explore is based entirely on what you have already, how that progresses you towards your goals, and then what you think is missing. Let's say, for example, you look at this and you're like, well, one of the things I want to be able to do is trade all market conditions. I see that I have something for downside breakouts, but I'm missing some sort of downside momentum. So maybe that's something I need to prioritize a little bit higher. Another thing that clearly is missing here is some sort of short vol. So short vol, long vol offer you some pretty good non-correlated returns. That's missing from here, and so on. In the other scenario, if my goal is to maximize my 5-year growth, then I need to see which one of these I expect to return the best. The other thing that you can think about is, do any of these overlap in any sort of way, and are there economies of scale? Let's say that this one is some sort of like downside momentum. And then let's say that this one is downside rotation, sector rotation or whatever, kind of similar stuff, but doesn't matter. In my analysis of this, I'm already going to be looking at similar stuff as I am with this. So then there's no reason for me not to test these two together. Different strategies, but as I'm going through the testing process, I'll just test both of these strategies at once. So then rather than doing each as some sort of unique unicorn, if they're cousins, let them be something that you look at together. So you can be as efficient as you want, provided that you have what you're doing defined. But in the original question, in terms of limited risk positions for earnings, I rarely use them. And I do have a video about trading earnings with options. I actually think I did one not that long ago. Maybe I'm wrong. That's a lie. Did it super long ago. Okay, so it is time to refresh that for sure. So this is the old one, which is from almost 3 years ago. So that one's, let's keep it a buck. That one's pretty dated. I'll add that to my to-do list, that I need to do an updated earnings trading video, because I definitely do need to update that. That's pretty fucking old. Anyways, the way that I trade earnings is I'm overwhelmingly not going to add those wings. It's the same reason why when I'm trading stuff like 0DTEs, I don't want the wings. It's why in general, I try to steer in context or in theory away from stuff like vertical spreads. We're actually going to talk about vertical spreads on the Friday beginner stream. And I had an interesting back and forth comment / discussion in YouTube with somebody about verticals, and they have a misunderstanding of what makes them what they are. But that said, it's a great example of like why I'm not a fan of verticals in general. In general, when you're trading spreads, you are neutering the underlying thing that you're trying to do. That's not to suggest that there's never a time and place for spreads. There are. But in general, they're pretty fucking inefficient. So, and when I say inefficient, it's not in terms of capital. They're going to be more efficient in terms of capital, but I mean in terms of actually attacking the profit mechanism that you're interested in. So I don't know if you're on the stream, but I'll also tag you in the Discord and let you know that I took a look at your question. Covered this tonight about 35-40 in, so that you know what's up. Anything else that you guys want to take a look at before we wrap up for the evening? Anything look interesting to you guys out there? Right now, as always, I continue to think that there's a million things to do in the market. There's so many opportunities that it really is kind of like your pick. There's a ton of weakness that can be traded, especially in utilities. Utilities has been sick for a while. If you take a look at the sell-off that's undergoing, and you can see that it's now just breaking out again to the downside, like utilities is sick. This is another easy place to find weakness. That's a big thing that I'm doing right now when I'm looking for some sort of downside deltas, easy place to get it. The other thing is, even though volatility is low, we're coming into earnings. And you know what that means. Earnings brings volatility, and no shortage of it, by the way. There's a lot that you can do in terms of vol with earnings. Reese says, thoughts on tech. So in general, actually, I didn't take a look at this yet, which I wanted to, which is a great reminder. I wanted to look at what, no, not this. I wanted to look at what the movement has been. Okay. So that actually doesn't look as bad. It doesn't look as bad, but it definitely looks like it's slowing. What I think is going on in tech is it's a little bit of a digestion period. I think that it's been so concentrated for so long that, I mean, everything has to take a breather once in a while. And this actually does not look good now that I'm looking a little bit more closely at it. I actually really am fascinated that there was a doji today as well. I'm going to leave that one just because I want to keep some sort of consistency here, but this is the more relevant channel that we're in. What was the volume like today? The volume here looked good. This volume doesn't look great. That volume does not look great at all. And then what's going on? Because, oh, that's interesting. Wait, one sec. I got to log in. Dude, let me log in. What the fuck? There we go. Okay. Wasn't letting me use my little setup, which is annoying. Okay, this is better. So the interesting thing is, like, the downside move here isn't that nasty in terms of names or in terms of depth. And there's not that many names in here that are like disgustingly far off of 52-week highs. It's kind of like from like this 20% handle up. That's far off of 52-week highs. And most of these are actually a little bit smaller as well. So I think it's digestion. But I also think that this is a great, absolutely profound time to look for leaders. Literally like Micron. Micron is absolutely a leader right now that's showing good post-earnings announcement drift, which I don't have a position on indirectly, but it did come across my scanner. I have a position on in here for one of the other accounts I manage. I think my brother's, not my mom's account, but in my brother's account, we have something on in here just playing that drift. The cool part is when the sector actually starts to turn around, stuff like this will skyrocket. But yeah, definitely looks a little bit weak right now. And then I agree about Nvidia. There's a couple different time frames that you can run with something like Nvidia. You can trade the short term, which the short term really isn't that impressive for it. But the longer term thesis, I certainly am not bearish in Nvidia longer term. But in the shorter term, I definitely think it can still go through some pretty strong turnover. And it wouldn't surprise me to see it that way. But that I don't think leads to like huge downside unwind in here. I think that would take some sort of really negative, broader market trend to cause that. Otherwise, super unlikely, I think. Osanano says, what's your assessment of those names because of CES? SNDK seems to be hold. Seems like a stronger buy signal. Let's see. SNDK. SND. Yeah. I mean, that's a good move. That's a clear breakout. And right now it's continuing. How did it do in this earnings? It beat. Yeah. That looks, I mean, that looks good to me. This looks very reasonable. Stuff like this, I personally am less interested in trading. This is not where I spend most of my directional trading, and it's literally just because of what's in it. So what I mean by that is if we look at something like SNDK and we go to institutional sponsorship, it's kind of like it starts to have a decent amount of it that's already bought up. Between this, what is this, 15, 12, 11, 3, 2, 2, 2, 2. So still has room to be sponsored more, but it's got a decent amount already locked up in institutions, which, yeah, it's just not typically my favorite. Moving fine though. Yeah, I definitely would call that a solid breakout. That's 23% in a couple of days. That's super, super strong, especially for something like this, because this isn't a super small company. So yeah, I definitely agree. I think that one looks pretty good. Sweet. All right, gang. Tomorrow we're doing sector rotation study. Friday, we're going to talk about vertical spreads. So as always, if you guys need anything, hit me up in the Discord. Be an outlier. See you guys later.